What happens to your debt when you die? Here is a question most people never think about until it is too late. You have credit card debt, a car loan, maybe a mortgage. What actually happens to all of it when you die? Does your family inherit your debt? Can credit card companies come after your spouse or your kids? The answers might surprise you, and knowing them now could save your family from a financial nightmare later. Welcome to Fuel Your Wealth. Let's get into it. The first thing to understand is that debt does not simply disappear when someone dies. It becomes the responsibility of the estate. Your estate is everything you own: your bank accounts, your home, your investments, your car, your personal property. Before any of that can be passed on to your heirs, your debts have to be settled first. Here is how it works. When you die, your estate goes through a legal process called probate. During probate, creditors are notified and given a window to file claims against the estate. The executor, whoever is managing your estate, uses the estate's assets to pay off valid debts in a legally required order. Only after debts are paid does whatever remains get distributed to your heirs. So your family does not inherit your debt, but they could inherit less than you intended or nothing at all if your debts consume your estate. Now let's break down the different types of debt because they do not all work the same way. Credit card debt. This is unsecured debt, meaning it is not tied to a specific asset. If you die with a $10,000 credit card balance, that bill goes to your estate. If your estate has enough assets, the estate pays it. If your estate does not have enough to cover it, that debt goes unpaid and the credit card company typically takes the loss. Here is the critical part. Your family members are generally not responsible for your credit card debt unless they were a joint account holder. Being an authorized user on a card is different from being a joint holder. An authorized user is not liable for the debt, mortgage debt. This is secured debt. The loan is tied to the house. If you die with a mortgage, the loan does not disappear. Whoever inherits the home also inherits the obligation to keep making payments or sell the home to pay off the loan. If no one wants the home or can afford the payments, the lender can foreclose on it. Car loans, same concept as mortgages. Whoever inherits the car needs to either keep making payments, pay off the loan, or give the car back to the lender. Student loans. Federal student loans are discharged, meaning canceled, when the borrower dies. Your family will not owe federal student loan debt. Private student loans are different. Some private lenders discharge the debt at death, but many do not. If a parent co-signed a private student loan, that co-signer may become responsible for the full balance when the primary borrower dies. This is one of the most overlooked financial traps for families. Medical debt. This goes to the estate like credit card debt. In most states, family members are not personally responsible for a deceased person's medical bills unless they signed a financial responsibility agreement. However, the estate must address these debts before assets are distributed to heirs. There are some important exceptions to know about. Married couples in community property states, which include California, Texas, Arizona, and a few others, may share liability for debts taken on during the marriage, even if only one spouse's name is on the account. This varies significantly by state, so understanding your state's rules matters. So what can you do right now to protect your family? First, life insurance. A term life insurance policy is one of the most cost-effective ways to ensure your family is not left dealing with your debts and no assets to cover them. For most people in their 30s and 40s, a 20-year term policy can cost less than $50 a month. Second, avoid co-signing. When someone co-signs a loan with you, they become fully responsible for that debt if you cannot pay, including if you die. Be very thoughtful before asking someone to co-sign anything for you. Third, keep a clear record of your debts and accounts. Make sure someone you trust knows where your accounts are, what you owe, and where to find your important financial documents. This makes the estate process much less painful for your family. Fourth, consider working with an estate attorney to set up a will or trust that clearly outlines your wishes and can potentially protect certain assets from the probate process. If you found this helpful, please like this video and subscribe to Fuel Your Wealth for more videos like this every week. This is not financial or legal advice. Always do your own research and consult a professional.